You've seen the headlines. Buy-to-let cars have collapsed and left investors high and dry. Don't fall for these schemes. Hi everyone, I'm Martin Bamford, and I'm here to tell you a few things about buy-to-let cars that will help you make an informed decision before investing your hard-earned money in schemes like this. Buy-to-let cars has entered administration this week, not long after the city regulator, the Financial Conduct Authority or FCA, ordered it to stop accepting new investments because of concerns they had about the company's finances. Before they collapsed, the company described the FCA notice as bizarre, and they accused the FCA of placing jobs at risk. Before I get into the details and the lessons we can all learn from buy-to-let cars, please take a second to smash the like button. It's the single most helpful thing you can do to support my channel, as it tells YouTube to show this video to more viewers. Go on, give that like button a little tickle now. Buy-to-let cars was a car hire scheme. They promised big returns to investors, using the money to buy cars, which they subsequently hired to people with poor credit ratings. Investment returns of up to 11% a year were being promised to investors who were asked to lend the business a minimum of £7,000 over a 3-year period. Buy-to-let cars used that money to buy new vehicles and then leased them to people with a poor credit history, leased them via a sister company called Wheels for Sure. In return for their investments, investors were supposed to receive monthly payments for the term of the loan, with interest also added at the end of the 3-year term. As I read through this, so many red flags. This structure of investing money, where investors are asked to lend money to an unregulated business, this investment structure is unregulated, so it's not subject to FCA regulation. As a result, investors don't get any level of consumer protection that they would have received if they had invested via a regulated business. That means investors will not now have recourse to the safety net of the Financial Services Compensation Scheme, the FSCS. However, as we've seen in the press this week, the FCA can stop buy-to-let cars from arranging new leases or accepting new investor money. I think we can learn so many lessons from the collapse of buy-to-let cars, and while I feel sorry for investors who will lose money as a result of getting caught up in this, as I said, the warning signs were there. If something looks too good to be true, it usually is. I don't know how many times we need to keep saying that. This scheme was offering an 11% annual return to investors. On a good day right now, you might get about 1% return from cash savings in a bank or building society account. There is an unbreakable link between risk and reward. If you want the potential for a greater reward from your investments, you have to be prepared to take more risk with your money. And those risks do include the loss of income and the loss of capital. Reading through some of the press reports about the collapse of buy-to-let cars, there are stories of investors who are losing their entire life savings. One anonymous review on Trustpilot said, "I've invested over £60,000 in this company. Could someone help me on what to do next, as no one is picking up their phone?" A fundamental principle of investing money is diversification. Do not place all of your eggs in one basket. You should spread your investments across multiple asset classes, multiple investment companies, because if one goes wrong, you've still got the other investments in place. This concentration risk we're seeing is something that's happening to a growing extent amongst investors who are placing their money at risk of complete loss. You also have to question the wisdom of an investor who places their money with an unregulated business. There is no need to go outside of authorised and regulated UK financial services businesses when it comes to investing money. Regulation is there for a reason. It's only when a company is authorised and regulated by the FCA that you get access to the Independent Complaints Arbitrator, the Financial Ombudsman Service, or FOS, and that safety net of the Financial Services Compensation Scheme, the FSCS. Regulated businesses also have to operate in a manner which is fit and proper. They have to be well capitalized. They have to hold professional indemnity insurance. They have to segregate client assets away from their business assets. So in the case of a business going bust, the creditors can't call on client money to pay the debt. Sadly, this does already appear to be yet another example, though, of regulatory failure. According to press reports, the Financial Conduct Authority was first warned about issues with buy-to-let cars all the way back in 2019. They were told back then the parent company Radex Consortium had massive losses, liabilities far exceeding their assets, and a financial situation which was getting slowly worse year after year. But they didn't choose to intervene until this week. There are some concerns raised in the press articles that this business was trading while insolvent, which, if that proves to be the case, that is illegal in the UK. They had £14 million worth of assets, their fleet of cars, but liabilities outstanding of £34 million. The business had lost £10.5 million over the last 3 years, and according to this FCA notice, they wouldn't be able to pay their debts, which included repayments to investors, unless they could find and raise a further £34 million of assets over the next 3 years. That made their financial position, their business model, unsustainable, and it was placing investors at a direct risk of loss. According to the FCA, the company claimed to own 1,200 cars, but there were some question marks over the value of these assets. The FCA looked at a sample of 102 vehicles, and 55 of those were second-hand. That's even though Buy2Let Cars were claiming that used vehicles were a minority of its fleet because the business model relied on securing deep discounts when buying new cars. Several of the vehicles in that sample of 102 cars could not be found on the DVLA database, and 18 leases in respect of those 102 cars were registered as having started significantly before the vehicle was registered and on the road. Accounting firm RSM has been appointed as the administrator and will obviously now do its best to recoup funds for investors, but I have to say this does not look good. I don't know how many times we have to see examples like this before people stop putting their money in stupid things. I get that the return on cash right now, the return on many asset classes, is not attractive. We're in this historically low interest rate environment, and I can understand the appeal of these attractive looking investment returns, especially when they're backed up by fancy marketing and a good story. But nothing good comes from going off-piste with investments. Nothing good comes from investing money in unregulated businesses where you don't have those important regulatory safety nets in place. Please seek professional, independent financial advice before you start going into non-mainstream assets and investments like this one. Get a second opinion at the very least, and never expose all of your money to schemes like this, even if they've got a relatively high minimum investment requirement. If an investment scheme requires you to tie your money up for a minimum period, say 3 years, that should probably raise a few red flags too. Investing is not fundamentally difficult to do well. Stick to mainstream investment assets, equities, fixed income securities, commercial property. Diversify your portfolio so you're not overexposed to one particular investment type. Invest for the long term. Be prepared to ride through short-term market volatility. Link your investment decisions to your overall financial planning goals, so you're investing money with purpose, not just for the sake of trying to grow your capital. And please, whatever you do stick to authorized and regulated investment providers. Investing like this may not be sexy or exciting. In fact, the best investing is quite dull. It's boring, but it does dramatically reduce your chances of getting caught up in a collapse like this one and risking the total loss of your investment. I look forward to the inevitable inquiry into the role of the Financial Conduct Authority in all of this. I don't look forward to the inevitable attempt to dump the compensation costs on regulated financial services businesses like mine through a levy on the Financial Services Compensation Scheme. That must not happen in this case. This was not a regulated business. There was no expectation from investors to have access to the FSCS should things go wrong. But please do use this as an example of how not to invest money, how not to get involved in these type of schemes. You must avoid these schemes at all costs. And if you're in something now that looks even slightly similar to this Buy2Let Cars scheme, do get out before it's too late. Don't wait until the inevitable collapse happens. What do you think about the collapse of Buy2Let Cars and the lessons that we can learn from yet another high-profile example of a high-risk, unregulated investment scheme? What can we learn from this to make better investment decisions in the future? Do let me know in the comments. If you found this video helpful, there's one super quick thing you can do right this second to support my channel. Smash the like button. And if you fancy being an even bigger supporter, why not share this video with your social network or with a friend who you think might get something out of watching it? Press that share button now. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.